What's up, y'all? We're going to teach you how to make offers on rental properties sight unseen today. It's not that hard. It's really efficient. It's just a good way to do business. And it's very 2021. So get used to it because I think it's going to happen a lot more often, not just because of everything that's happened during the pandemic, but also just the direction of real estate, where it's moving, where money is coming from, bigger cities, and where it's going to, a variety of different markets around the country. It's being dispersed all over the place, right? So making sight unseen offers is a really important part of being an efficient real estate investor that can actually compete with the other investors out there. Now, before we get started, I got some bad news for you today. I was supposed to bring a special bottle of whiskey, a very special bottle of whiskey, and I forgot it at home. So I'm drinking coffee today. You're gonna be really disappointed with me. I know it's not very Ace Live of us to have a coffee on us, but you're gonna have to deal with it. I'm not even caffeinated yet, so maybe you get a more reasonably paced version of me on this live today. I got a coupon code for you, by the way. I was supposed to tell you in the very beginning of it. Now the coupon is not active yet, right? I'm gonna post a link in a story after the live that has this coupon code not included on it, sorry. But if you were here, you have it and you'll know that it's active when I announce it after the live. The coupon code, if you could see it and read backwards, it's sight unseen, SITEUNSEEN. It's not sight, SIGHT unseen. That's one of my biggest pet peeves, by the way, right? People go, yeah, I'm gonna buy that thing sight unseen. Like my sight is unseen, which actually is kind of like an oxymoron, right? Or redundant, not an oxymoron. So it's sight unseen, SITE, right? You're not seeing the site of the property. But anyways, yeah, it is. Oh, it's 8:30 p.m. where you are? Man, I'm getting on the nighttime lives with you guys, so no coffee for you. Maybe you're the one having a whiskey today. Why do we make sight unseen offers? What's the point of making a sight unseen offer? It's all about efficiency. It's all about efficiency. It's all about making offers sooner, faster. It's about disqualifying the wrong deals earlier and with less effort. And it's really all about being able to make more offers per day and more of your offers being successful, right? So efficiency is big, and you don't really see the efficiency of it until you look at the process of an in-person offer. It's really arduous. It's really, really laborious. You get to a property. Imagine you see a listing. You arrange with the broker, or you have your broker arrange with their broker, or you call the seller. Maybe it's a direct-to-seller type deal. It's off-market, right? And you show up to the property, you look around, you ask a bunch of questions, you hang out, you kind of like pre-negotiate while you're there with them. You set these weird standards. It's like kind of like a weird like chess match while you're viewing the property. You look at all this stuff that you didn't really need to see to determine a price, and then you go back, crunch your numbers, call the seller back, give them your offer, they don't like it, they give you a counter offer, back and forth. And then you do a physical inspection if you happen to get into contract anyways. But active real estate investors here know that you don't really get into contract on most of the deals that you see or that come through your pipeline, right? You don't even get into contract on most of the deals that you offer on, right? So why would you go to a property and do this like due diligence, this in-person due diligence that should happen much later in the process, when most properties that come through your pipeline that are considered don't even get an offer? And the ones that get the offers, most of them don't sign or end up being a deal, right? It's all about prioritization of your sales funnel. We were seeing offices. We were looking at office buildings back in like May and June, Mike and I. We wanted to purchase a small office building for ourselves, figured we can get a low-cost loan. High LTV, those SBA loans will give you 90%, and they'll wrap in like rehab costs into the loan, and there's some good tax write-offs and all that. And we saw like 4 or 5 offices, and the amount of time it took to drive over there, scope the neighborhood, check out the building. After like 4, we were exhausted because none of them were even deals we were really preparing to offer on. I think we made an offer on one of them, and it had to be a lowball offer because the deal didn't make sense. And that's another thing too, is going somewhere just to make a lowball offer because you already sunk all the time into seeing it. Lowball offers don't get accepted, right? So on the phone, when we take these virtual calls and manage a pipeline virtually, we don't even make the lowball offers. We get a price right off the bat, get the info right off the bat, and go, look, this one's just not going to work because of price, and we move on to the next one within minutes, not hours. So we actually gave up on the office hunt because we didn't have time. We didn't have time. We were doing other deals. We're doing other stuff for the business, right? So digging in to these offices just to grab something that wasn't that important to us, a single purchase, it was taking up half of our day every single time we went to do it, right? Because we'd talk about the deal before and after, get there early, walk around, chat with the broker after seeing the building. It was a 3 or 4 hour ordeal every single viewing. Whereas on the phone over here, it can be as short as 2 or 3 minutes. And for an exhaustive preliminary due diligence, right, pre-offer due diligence, it could be as short as 20 minutes, 25 minutes if you have a good deal on your hands. So it's quite important to be efficient in your pipeline management process if you want to see enough deals. Because look, in this market, inventory is so damn tight that you're not going to even get most of the deals you're getting after. You got to see so many deals. You need so much volume just to have a few successful conversions that you got to change the process. You got to change it. By the way, have you guys noticed that my cheek is still like on this side from my gym incident? That if you don't know what it is, then I'm not even going to repeat it because I already mentioned this story a couple times. Look, what's the alternative to seeing the property and then making the offer after all this viewing and all this work? It's making a virtual offer, right? We have made it a point to make the virtual offer since we started this business 4 years ago. That was the whole point of the business, was we don't need to follow the old standard of real estate acquisition. We need to build kind of a new method that allows us to stand apart and also see a lot more deals a lot faster and have a more efficient business model too, right? Which means like less employees per number of evaluated deals. Which for someone with no employees, that's really important also, right? Because you don't want to have to need an employee because you don't have time to evaluate deals, or you don't want to have to pass up on evaluating deals because it takes too long to evaluate each one. So you're not even getting deals into your pipeline in the first place, right? You're passing up on opportunities essentially, or you're trading a lot of money and time for them. So how do you make a virtual offer? Well, before you actually get into gathering the information you need, you obviously need some basic property information, right? It's preliminary information. You need like an address and a unit breakdown. That's about it. And like the seller's contact info or the realtor's contact info or whatever it is, right? But address and a unit breakdown is enough to get you started. Just write that down somewhere, put it in your database. I don't really think writing it down is maybe the best idea. Maybe like have, at the worst, like a Google Sheet, at the best, like a CRM, right? Podio or Salesforce or something like that. If you're extreme, use Salesforce. If you're not, then just don't bother, use Podio or something like that. Get that preliminary information, and then you want to go financials first. Now, the reason I'm going financials first is because this is all about prioritization. You want to focus on the information that is going to be most likely to disqualify the deal earliest in the evaluation process, right? Because why would you go through and ask all these condition questions to find out the property's in great condition, ask all these tenant questions to find out the tenant situation's acceptable, just to get to the end and ask for the rents and the expenses and the asking price, and then find out that the seller wants way too much, or the rents are way too low, or a combination of the two, or the utilities are way too high, right? And I'm going to record this live later. And you want to ask the important questions first. It's kind of like the day prioritization, time management activities that people recommend. They say, come do the hard work first. Come do the most difficult or the most unpleasant task first thing in the morning when you get to the office. You want to do the same thing when you're managing a sales funnel, right? And don't get it wrong. Your acquisitions pipeline is a sales funnel. So you definitely need to qualify the most important components of the deal as early as possible. And that is the financials, because that's what blows the deal most of the time. It's either the price is too high, the rents are too low, the utilities are way off, or the price needs to be significantly lower because of the other financial circumstances of the property. What do you want to get on a first call, right? We call this our call one. The first call with a seller, with a seller's broker, with anyone like that. You're going to want to get the first thing, current rents. And you want to get kind of a unit breakdown with it, right? Like attach each rent to each unit so you have some sort of traceability when you're going to crunch your numbers later. You want to get the current rents. You want to get the tenant duration. And I'll tell you why this is important in a second. And you want to get the utilities information, which utilities are owner paid specifically, so that one, you can get an estimate from the seller or the broker over the phone, right? Hey, what do you pay, and about how much is it every month or every year, or every 3 months, whenever the bill is paid, right? Whatever period it's paid on. But you also want to have the meters that you expect the seller to pay, so that if you need to call the utilities company, and most utilities companies that we've worked with have been willing to share some average meter usage history over time. You could say, hey, this public meter, this meter for this particular part of the building, and this meter right here, seller pays for these. What are the usage history or usage records for these particular meters, and you'll be able to plug that into your pro forma with some accuracy, right? So you want to get the utilities that they pay for, and you also want to get the asking price, guys. The number one thing that kills the deal is the price. The number one thing that kills the deal is the price. So why wouldn't you get that as early as possible? Obviously, with a listing, there's a list price, right? But even with a listing, you got to say, hey, where's the seller really willing to go? If it's publicly listed on the MLS. So current rents, tenant duration, utilities, price. Why is tenant duration important? If a tenant's been in a unit for, let's say, so the most common thing we see with especially mom and pop owned buildings or long-term owned buildings or just any building that gets sold is under rented units. Under rented units, that's the biggest stabilization component in an otherwise clean property, is the units being under rented. If the units are significantly under rented, but you have long-term tenants throughout, then that kind of sweetens the situation a little bit. Why does it sweeten the situation? Because tenants that don't leave don't cost you money. It's simple as that. If a tenant's been there for 5 years, if all your tenants in a fourplex have been there for 5 years, your vacancy budget goes away, right? You don't have to worry about them being gone for a month before you find a new tenant, or 6 weeks or 8 weeks, whatever it takes to find a new tenant, right? You don't have to worry about the cost of turning the actual unit, like the renovations, until they leave, or the cleaning costs or the wear and tear, whatever it might be. You don't have to worry about paying the property manager half of first month's rent, or in some cases, all of first month's rent to find a new tenant afterwards. And you don't have to worry about the performance and competence of your property manager in this case to be able to execute all these things perfectly, right? So if it's under rented, yeah, that's not a great thing. If it's under rented, but you've got long-term tenants, or maybe it's at market rent, you've got long-term tenants, you need to factor that in to the offer you're willing to make, or at least reduce your vacancy reserve at current rents on your pro forma, and then leave it on your market rents pro forma once it's all been stabilized, right? But on your current rent side of your pro forma, if you guys have like the Invest with Ace deal calculator, you know that we do a current rents and market rents, right? On the current rent side, if you've got all long-term tenants, you can put a 0 vacancy reserve, knowing that you will incur a vacancy reserve once the property gets to market. But for now, with these tenants, you don't have to worry about that. So tenant duration is really important. After you get this information from a seller, and if you're good enough at your market, the type of property you're trying to buy, you can also give the seller some feedback on the asking price. Hey, that sounds high. Hey, we might be able to get pretty close to that, or we're going to be significantly off of that. If that price doesn't sound too crazy, if the situation sounds like it might be something, then you want to move on to step 2, and that's research. You want to research and get the following information. You want to get market rents. That's a big one, especially if the property's you feel that it's under rented. If you don't know the market rents, you'll never know it's under rented either. So you need to go and get market rents. We like to use actual comparables to get market rents, and then personal feedback from property managers. Actual comparables comes from listings that are on the market right now. You could look at Zillow, you can Craigslist, whatever. You can look at Craigslist if you want to. You can look at apartments.com. Make sure you're comparing to like-kind buildings. Don't take your fourplex like in a kind of like working class neighborhood and go find a nice big institutional apartment complex that's like got all the amenities and professional management and all that stuff, and comp your rents out to that. Comp it out to a similar building. If you want to spend a little bit of money, and I recommend this if you're analyzing a lot of deals, and I'm not paid by them. I was working an affiliate deal with them, it didn't work out. But Rentometer, we use Rentometer Pro. What they do is they scrape the internet for like all historical rental listings, and before they get pulled off the market, when the units actually get filled, they grab that data and they store it in a database, right? So Rentometer's got all this data on like historical rental listings, and you can comp out your property with a lot more data. I wouldn't use like the averages it spits out at the top when you plug in the address of the property, but I would use all the list of comparables at the bottom and actually go check out each one and say, which one of these does my property match up most closely with, and what's a reasonable market rent for this unit? So you want to get market rents, you want to get the property taxes. You get these from the county records. You go on the assessor's site and you'll be able to see the tax assessment. You go on the treasurer's site, you'll be able to see the tax bill. Pay attention to the assessment and understand if it's going to go up if you purchase the property for a higher price than what it's currently assessed at, because some of these sellers have owned the property for a long time, or they bought in the crash for really cheap, so their tax assessment never really went up. It's really low in some cases. They pay a really low tax bill, and maybe next year you have a higher tax bill that you have to pay on this particular property, right? So look up the tax assessment and the current tax bill and understand reassessment risk. If you don't know how to do this by looking at like comps in the area, you don't know the market, or like researching through the assessor's site, call the assessor's office and go, hey, I'm looking at this property, especially if you think the price is going to work out, right? You don't want to waste a lot of effort before you think the numbers are going to work out. But if you think the numbers are going to work out, maybe you want to make a quick call to the assessor's office and say, hey, if I buy this property for this price, where should the tax bill land after purchase? And see what they have to say so you can get the right tax number, plug it into your pro forma. And you want to get insurance, right? Now, if you've been dealing with an area enough, you can eyeball insurance and just guess. It's pretty easy. But if you haven't been dealing in an area for a long time, you can always just call up your broker or a couple different brokers or insurance companies in the area and say, Give me a quote. Give me a quote. And this does take time. I would say it's a little bit of a waste of time if you do it for every deal, but if you do it for enough deals, you won't have to do it anymore. You'll be able to ballpark it pretty close within like several dollars out of direction. And then in the future, you won't have to get that quote until you're actually in escrow. You'll be able to just estimate in advance, right? And it won't make or break you if the deal is good enough. If your insurance estimate is relatively accurate and it being different breaks the deal, that means the deal wasn't good enough, right? If like $20 or $30 a month breaks the deal, it wasn't good enough in the first place. So you want to get all those details when you do your research: market rents, taxes, and insurance. Now you want to go ahead and set the cap rate. You want to get into your calculator, maybe my calculator, and plug in current rents, market rents, and all the expenses we just discussed, right? And if there is potential for like a high cost of landscaping and snow removal, maybe you want to have a higher maintenance reserve or add that in, right? You want to add that water bill in. You want to add that's paid by the owner. You want to add any utilities that are paid by the owner: electric, gas, common areas, single heating units for a whole building, right? Outside lights, laundry. Those are all owner-paid utilities, right? That's why you ask the seller for these things in advance. Plug in all those expenses, plug in the mortgage rates and terms that you expect that you'll get. But you know what? I don't make offers based on ROI after mortgage. I make offers based on the property's cap rate. So you want to set the cap rate with all the income and expenses. Now you have two sets of incomes, right? The current and the market. And actually your expenses could vary too, because remember what we said about like vacancy being 0% if the tenants are long-term. Well, maybe on your current pro forma, you reflect the current income and expenses. Maybe you have some tenants that are not paying for their own utilities, but you could charge them, but for some reason the seller's paying it, right? So make sure your current pro forma and your market or your stabilized pro forma are both set using their respective income and expenses. And then you want to set the cap rate always based on the market rents. Always based on the market rents, assuming the property's in generally good condition. Now you want to go ahead and ask the seller gently, without getting too far in this conversation on that first call: hey, is the property generally well maintained? I'll ask you more condition questions later, but just overall, is it pretty good, right? Just to make sure it's not like gonna kill the deal, right? And you're gonna do all this work for nothing. So if the property is generally well maintained, you set the cap rate based on the market rents, the market expenses, the stabilized pro forma. And we're gonna do that because we're gonna adjust backwards for the current situation, because one of our big cost adjustments is the cost, time, and effort of stabilization. The path to stabilization is something we use to adjust costs downwards. Now, how do you set the cap rate correctly? It's based on the cap rate that you want to get in that market. That cap rate is going to be loosely based on market values or whatever discount from market value you aim to get. If it's an 8 cap market and you're okay buying at market price if it's a good building, then set market rents at an 8 cap and you could subtract all the reasons that it should be cheaper later. If you want to buy at a discount, the property's an 8 cap at market, maybe you offer at a 10 cap, right? If that's what you are, if you have the ability to get those kind of properties. So set the market rents and market expenses table at a purchase price that gets you the cap rate that you desire. Work your way backwards. Now, how far do you work your way backwards if it's under rented? Well, maybe the property's a 8 cap on your stabilized pro forma, but it's only a 5 now. Well, man, then you've got to really get into some questions. If it's just a matter of getting rents up, then maybe you can look for an amount of credits over the course of a year. You could say, hey, these rents are $500 under in total, in aggregate, and it's going to take me at least a year and a half over time to realistically get these things up that high. I'm going to want $500 times 18 months in credits back. Or it could be further than that, right? If you want that plus a premium for the amount of effort that you have to put in, because maybe you want to go find another property that's already at market rents instead of paying that price, right? If you have that option. If you want to place a premium for your effort, you can place a premium for your effort on top of that. You could double it, triple it, whatever it might be, whatever you think is appropriate for the market and for the scenario and for the negotiation, right? And that's a big part of it, is understanding your seller and how willing and wanting you are of that particular deal is going to be a really big factor in deciding how to place a premium on extra effort, right? So subtract for under renting, and then you want to get a preliminary number. Once you subtract it for under renting and all that stuff, you have your financials, right? Get your number. Call that seller back if you think it makes sense, right? If you think it doesn't, you can still call them back and go, hey, I'm way off. I'm significantly lower than you. Do you have a good amount of room? You don't even give them the number. Do you have a good amount of room? And if they say, sure, I'm willing to talk, or what are we talking, then you can say, I mean, I don't know, like this thing's so under rented that I was thinking, something closer to this. Can I ask you a couple more questions? Don't let them sit on the number. Just let them tell you, no, it's not even worth talking, or yeah, sure, ask your questions. That means they're willing to work with you a little bit, right? And then you want to work your way into these following pieces of information. The next one is going to be tenant info. I'm not going to go super deep into each of these things. I'm just going to tell you what they are and how to do your research. For tenant info, you want the lease terms. You know how long they've been there already, right? So you want to know if they're month to month, on a year lease. This will give you an idea of if you can increase rents sooner or later, what the path to increasing rents looks like. Is going to be really important to find out this tenant information. That's going to transcend these questions. You're going to see that. So you want to know the deposit they've placed, when the lease started, when the lease ends. You already know how long they've been there. If they're month to month, you can increase relatively quickly legally, but you don't necessarily want to lose a tenant. So you want to ask these follow-up questions too about the tenant's dynamics in the household. Who's living there? How many of them? What are they doing for work? When's the last time you increased rent on them? Could they afford a rent increase? Flat out asking, could they afford an increase? Maybe not in a hurry, but gradually. Could they afford an increase? And these sellers will be pretty honest with you, and they'll tell you what these tenants do sometimes, and you'll be able to know if they could afford a rent increase. Hopefully, they're pretty honest with you. You want to do your due diligence later, but we find a lot of success in getting some tenant color from sellers directly. Now, we don't work with brokers often, so I don't know how much success you'll have there. But we do work with sellers quite a bit, only really, and we find a lot of good information from them. They're pretty straightforward because we don't chase distressed properties where people are in a motivated situation and inclined to lie, maybe. So get that tenant information, get a feel for. Also, are they taking care of the unit? Are they clean? Are they performing? Are they paying on time? Are they getting behind? I mean, this is a perfect opportunity to see if tenants are able to perform, and also to find situations in which you have to understand that tenants might be behind because of this pandemic we've been dealing with, right? Some tenants have been behind, so you want to understand that situation pretty well, and you want to adjust for that too, but not yet. You want to go back and get information on the property's condition before you adjust for the price one more time, right? And that property condition is going to be basically all the mechanicals, all the structural components, and all the cosmetics. You're going to go through and find the age of roof, furnaces, central ACs if they're there, what type of windows and about when were they installed and the general condition of them, the siding of the property, the foundation of the property, and you want to ask pointed questions, right? And I have a whole live on condition and understand the verbal inspection that you can go into, but do you see seepage? How are the gutters? What's the reason for seepage? Is there shifting? Are there large cracks? Is there significant bowing in the foundation? All these things, right? Plumbing and electrical. Do you have knob and tube wiring? Is it Romex and up to code, right? Do you have circuit breakers or fuse boxes? Are the breakers of adequate amperage? Can they handle the current that they're supposed to be able to? Are fuses popping? Do you have galvanized plumbing, PEX tubes, or a combination, or all copper, or what, right? What's going on there? Do you see leaks? Do you see water pressure issues? And then you want to go through and do like a kind of a verbal, visualize the cosmetics of the units, but you don't want to kill the seller with overly nitpicky questions, or the broker with overly nitpicky questions. They'll get you off the phone, right? They're going to think you're not serious. What you want to ask are things like, hey, 4 units, what are these kitchens like? What are these bathrooms like? Am I going to have to remodel these as the tenants leave? Or is it just going to be paint and floors? And if it is, what kind of floors are we dealing with in these? Am I going to have to refloor all of these units? Because that could be pretty expensive. Is it going to need a full repaint, or are they pretty clean? What's going on inside these units cosmetically? And then you want to kind of make a mental scope of work based on the questions that you ask. And you want to be realistic. You don't want to abuse the seller with items that you wouldn't actually replace, right? Or that actually correlate to market condition. I'd say market condition is reasonable for a property with paint requirements in all 4 units of the tenant cycle. Maybe half of the units need partial refloor. I think those are things that you should be accepting and baking into your offer, especially if you're getting equity in the deal anyways, right? So, and if you're not even, you should understand that market condition corresponds to market value. We say this all the time here in this office. Market condition equals market value. Premium condition equals premium value. That's it. It's reasonable. So get all that condition information, do your verbal inspection, get a scope of work going, understand the path to increasing rents and the difficulty based on the tenant type that you're dealing with, in their situation, their lease, how far under they are, and then look at the financials. And then you want to go back to that cap rate that you kind of set before, that preliminary offer, and you want to adjust it downwards based on all this information here. You want to adjust it appropriately. You basically want to say, what's this going to cost me repair-wise? What kind of time is it going to take? What kind of management effort is it going to take? What kind of risks do we have in the management being able to succeed in improving these without having too much turnover? Are these tenants going to be compliant with the stabilization process? All of this information, package it all up, and then stick your premium on it. Your premium is based on what you're able to get, quite honestly, what you deserve, right? We expect a high premium because we're an acquisitions business. We need to make money. That's how we do it, right? And we have a lot of opportunities to do so. But if you're trying to get in and you have a pretty good deal that needs a little bit of stabilization, and you've had a hard time finding a deal which is reasonable in this market, and you don't have time to like funnel a lot of deals through an acquisitions engine, then you might not want to place an incredible premium on your efforts. You might want to place a reasonable premium so that the seller wants to work with you and everything is justifiable. And at that point, you're going to get to your final number, but before you give it to the seller, you want to go and pull comps. So if you don't have access to like the MLS, you have to go to Zillow or something like that and look at sales, right? Basically, I mean, PropStream could be better, right? I use PropStream. It's in the bio if you guys want to sign up. It's $100 a month, right? So it's not really cheap for people to analyze like one property a month. But we do property research like all day long, daily, right? So it's definitely worth it for us. But you can go on PropStream, look up comps. You can go on like Zillow and look at like previously sold properties in the area. You want to look within a reasonable timeline away from like today's date. You want to look within like a reasonable area around your property, or an area at least that's maybe not super nearby but comparable in like value and product type and like, you know, tenant class and demographic and all that other stuff. And you want to make sure the properties are like kind. You want to look at things like square footage, condition, if you can see like previous pictures and like quality of units. If there's any information on previous listings about what they're renting for, just pull those comps and look. You don't need to use the comps to adjust your price necessarily. You just need to use the comps to check your price, just validate your price, make sure that it's appropriate, it's giving you the amount of room that you're looking for in a property like this. Or maybe no room, but you want to make sure you're not paying over market value. If you are paying a premium, you want to make sure it's a reasonable premium compared to the other stuff that's sold in the area and that's available in the area. And look, people say don't look at listings. I don't understand why not, especially in a market where like properties reliably sell quite a bit at listing price and there's really limited inventory. I'm not saying you use them as comps, but have an idea of what else you can buy out there at what prices or what people are asking out there. And you might be able to use that in your negotiation and use that to gain a little bit of confidence in your purchase when you're making that offer, right? So that's kind of how you make your final offer. It is nebulous, but I want you to understand that the things that you want to account for are baselining to a cap rate at market rents and then subtracting for every unique and difficult situation that requires time, effort, money, and risk on you or your management company's part. Adjust for at least the cost of those things and then add a premium if you deserve the premium, you desire the premium for profit margin, essentially, right? Money that you deserve to make because of that effort that you're putting in or the deal that you found or whatever it might be. That is all for the sight unseen offers. That's the whole process. I tried to make it really concise for you guys. Hopefully it was helpful. This is kind of how we do it. The point of this here is you're going to kill most of the deals in that financial section. As soon as you get that asking price and the rents, most of the time you don't even have to plug it into a pro forma. Or you could plug, if you got the deal calc, you plug it in while you're on the phone. I mean, that's why we designed that. So you could just click, like without getting off the phone to have to give feedback to the seller. And you'll see right off the bat, more or less, like what your cap rate is and where you kind of need to be or where it's even, if it's even close based on the seller's price. You're going to kill most deals in the financial section. That's why viewing a property in person before you make an offer is horrible, because the first thing you do when you walk in the property is you look at condition. You look at all the conditions, and a condition takes a lot of time to evaluate. There's a lot of discussion to be had, and it's usually not what kills the deal. At least for us. It's usually not what kills the deal. It's usually dollars and cents and numbers that kill the deal. So that's why we make sight unseen offers. That's how you make a sight unseen offer. There's way more to understanding how to crunch the numbers, how to evaluate the tenants and management, how to evaluate condition, how to pull comps and value the property appropriately. I didn't go into all those things because I got a bunch of lives for you guys to dig in and understand all those on like an a la carte basis. So dig in. I'll do a little bit of Q&A. I got about 15 minutes of Q&A for you guys because we got to hop on over to a little work meeting and then we have to get out of here, take the team to brunch. We had a good quarter. I'm going to take the day off early. What do you got? So At what point would you consider a tenant long-term if you have them on a year-to-year lease? If they've completed their second lease or their second year, I'd consider them pretty long-term at that point, right? Because if you think of how vacancy works, like on a numerical basis, if the average vacancy on a stable unit that's in good condition is 30 days, right? Tenant moves out, another one moves in, and rent is paid again. 30-day loss, that's 1 month. So what is that if the tenant moves out yearly? 1 out of 12, right? So 8% vacancy if they move out yearly. If they're for 30 days, if you're missing 45 days, it's 1.5 out of 12, so it's 12% vacancy. And that might be a realistic vacancy reserve, especially for a first turn when you have to do some like renovation. So 8 to 12% vacancy if they move yearly. If they move every 2 years, right, that's a 4% vacancy rate. Now, if they're done with their second lease, they're on their third, and they move every 3 years, that's a 2% vacancy rate, right? No, sorry. It's 1 out of 36, right? So it's right around 3% flat, a little bit less than 3%, like 2.8% vacancy rate per unit. But at that point, they generally have the intention to stay quite a bit longer as well. So if they're way under market rent, then I won't include the vacancy reserve if they've been around for, they've completed their second lease, they're moving into their third. Now, we encounter like 5 and 10 year tenants a lot. We don't include a vacancy reserve for a 5-year tenant, even if it's pretty close to market. If it's right on market rent, we'll include it because there's no upside to be had if they move out, right? We kind of like rationalize not putting vacancy money aside when it's under rented because we go, well, shit, if they move, we're going to make more money on the property and the value of the property will increase, right? So it's not really like a cost that we're worried about. If they're at market and they've been there for a while, I still include a vacancy reserve. Maybe a lesser one if they've been there for a while and they intend to stay, but I still include it nonetheless. So if it's a value-add property, partially vacant, do you still not recommend visiting the property to estimate rental cost? Look, if the property is high level of value add and you can't confidently get that information over the phone before you at least like get to an offer, then you can go, but we've done a lot of renovations without even going, right? Because I mean, what's the point? Make sure the seller agrees to your number first. So get that verbal inspection and say, based on everything you've told me, this is what I'm gonna be able to pay for this property. And if you just can't stomach having to maybe pay for an inspection and burn the money on the cost of an inspection, which is, $400, $600, $800, $1,000, depending on how big the property is, right? For a single family home, $400 or $500. For a fourplex, $800, something like that, $900. If you can't stomach losing that money at the expense of you not having to spend your time going out to see the property, then at least hook the seller on a price based on what they say first, so you know that the financial barrier or hurdle is out of the way, and then say, cool, you know what, I'm gonna visit. Or I'll have my property manager visit before I send you the contract, right? But you might as well send the contract at that point and then just adjust afterwards. And maybe just get your property manager or a third party that could help you out with like photo and video out before you get a complete inspection. If you expect it to be in bad shape, just tell the seller, hey, before I spend $1,000 on inspection, I want a quick walkthrough with my trusted broker, my property manager, my boots on the ground, whatever it might be, myself, just to get a better visual of the property, make sure everything's good so I don't waste your time with a full inspection, because inspections take a long time and you've got to let them in and hang out there for several hours. How about we just do like a quick 20 minutes, 30 minutes to make sure that this isn't going to be a problem. I think that's a good angle. Do I buy home warranties on multifamilies? I tend not to. I mean, I've had bad experiences with home warranties, but I've had people tell me they've had good experiences with home warranties. So maybe that is something that you should consider. It's never really been something that I've loved, to be honest with you. This camera's too high, I just noticed that. If I'm close up here, it's good, but if I step back, then I'm like in the bottom half of the screen and you guys get to look at a lot of ceiling. How many of your unseen deals are off market or on MLS? I would say 99% are off market. We've gotten a very rare few deals that are publicly listed. Maybe not on the MLS, some of them are like for sale by owner. We just snag them out of like a Facebook group or something like that, or off market for way cheaper than like the FSBO price. Because sometimes people will like fish it out like lucky pricing as a for sale by owner, but they'll take an offer from like an investor that they're confident will close for way, way less. We had a property it was a duplex in Indiana, and it was like for sale by owner for 70 grand online. And I think he just like wasn't showing it very well. It was a wholesaler. And it was a good deal at 70 grand. It was a good deal. It wasn't a bad deal at 70 grand for sure. But we ended up getting it through a Facebook group, getting direct contact with this guy and getting it for $37,000. It was in good condition. It's under rented for like $1,100 or $1,150 a month for these two units combined. It is really under rented, but it's worth like at current rents, 90, something like that. I could definitely sell for 90. At market rents, if we got it up to like 1,400, what it's supposed to be, 110, 100, 105, something like that. So there are good deals to be had out there on the MLS. We get the vast majority off market though. Schaumburg, Illinois. Illinois is tough. Landlord-tenant law is really tough out there. The prices aren't necessarily cheap in places like that. The taxes are really high, so you really have to understand how reassessments work in that state, right? Like if you go to like a pretty low tax region and you get hit with a surprise reassessment that's like higher than you expected, it's probably not killing you, right? If you bought a good enough cap rate, maybe your 7 drops to a 6, but then you increase rents over time and you're good, right? But if you go into a place like Illinois or Texas or New Jersey or New York where the property tax rate is very, very high and the assessment is way lower than it's going to jump to when you buy the property, then yeah, the rate of change is the same. It may double, just like it doubles in a low tax state like Kentucky is a really low tax state, right, or Arkansas. But the gross dollar amount of change is so much that it could easily, especially in a low rent region, maybe a working class neighborhood in Illinois, which may not have very high market rents, it could really wipe out your cash flow hard. And those states with like high tax rates and landlord unfriendly laws or tenant friendly laws, they tend to have like high utility costs too. Like everything tends to be expensive in those states, right? So you can really get eaten alive in a high tax state like Illinois if you don't watch for reassessment. You could really get eaten alive by an unstable tenant situation because the law does not favor the landlord there, and your ability to understand with some sense of like predictability the property's tenant situation becomes really, really, really important for a property in an area like Schaumburg. So that's it. How do you avoid a lot of taxes and keep the same interest from a house my dad transfers to me? I don't do much with estates. I've never inherited a property. I've never passed along a property to someone. So I don't know. I've heard some people say like you can, put it in a trust that like you guys are both in charge of, and then he transfers the control of the trust to you or controlling interest. You're gonna want to talk to a CPA about that one. You definitely don't want to like evade it, right? You definitely don't want to fake it. So you gotta find legitimate means to be able to like kind of defer those taxes. You could also put it in that trust where you get some control. Maybe you take some distributions. I don't know. Like I said, talk to maybe a tax attorney or an estate planner or a CPA or a combination of the three. But upon death, right? And like, I'm not trying to talk about your dad dying, but I mean, one day when it gets to that point and the property is passed on to you, if your father dies, the basis does step up to the value of the property at the time of his death. And if you inherit the property at that point in time, then you get that new basis, right? So if you were to sell it at that moment, then you don't pay any capital gains tax. If you keep the property, obviously that's not a concern, but there is some level of like estate tax that happens when people pass along stuff when they pass away, if their estate is big enough. Like I said, accountant, but I gave you what I knew. Maybe you could talk to your accountant about some of the stuff that I kind of handed off to you just now. How many corps do I have for my personal rental properties? A handful. A handful. I mean, they're easy to make and manage, right? So make a couple. I live in Southeast Wisconsin. What's the best area to buy my first rental? If it's your first and you want to be cautious, I'd say like deal with like Kenosha and Racine where you're at. I like those markets, but deal with the property that's particularly stable, maybe pretty close to market rents, and don't go for like the highest turnover parts of town, right? Go for a part of town that's a little bit cleaner. The cash flow is still good. Deal with a slightly lower cap rate, and try to get a property that's maybe like mom and pop managed or mismanaged, so it's a good property, but there's a lot of room for upside. That might be a good deal. Just don't take on a big project at first, unless you got the guts for it and you're willing to, and you got the reserves to kind of withstand like some potential losses or just some surprises. Would I buy in Louisville or stick to 45 minutes outside? I do buy in Louisville. I own property in Louisville. It's a little tough because it is a bigger city, so there's like a lot of shopping in that market, and that does push the cap rates down. But the right deal can be found out there for sure, simply out of like volume and abundance. There's so much product in that city, just so much small multifamily and like C+ and B- and B neighborhoods. And I think there's a culture of like under renting with mom and pop landlords out there, because we find some really, really under rented properties out there, I would say at a higher frequency than we do in like Indiana and Wisconsin, that are in good shape, and they just have relationships with their tenants. And that means that the deal's not as sweet when you first get it, but maybe you can get it at a better price. and you've got a good amount of upside. So I like the market, but it is harder to make a deal. It becomes more of a volume game in that city. Going outside of town, to like Frankfurt or maybe other outskirts of Lexington, you could have some more success for sure, but you don't get the, the roots, the economic roots and stability of like the large city. Not to say that's necessary to be successful with a rental property. Everything's got a right price, right? Let's see what else. Thank you guys for staying and coming in early. I'm not going to tell your boss, by the way, I promise. Your boss is probably on this live too, so they're not going to give a shit if you're here. What do I think about Milwaukee? Same big city phenomenon as Louisville. You want to hit the areas that have a bunch of product. You want to avoid like the really, really difficult areas because it's not a very landlord-friendly state, and there are parts of the city that like managers don't want to touch. But if you can hit an area that has a lot of product and get a little bit lucky, then it could be good. It is definitely not as easy to make a deal happen there as it is in Louisville for us, but not to say that there aren't deals out there. How long have I been a landlord? 2016, I think. End of 2016 was when it first started. Sorry, I keep adjusting my camera because it's kind of acting weird on me. Biggest sight unseen lesson I learned early on. So many. Get third-party inspections. I learned that I don't like to deal with distressed sellers unless the property is like a complete steal, but don't deal with like heavy levels of distress at all. Like some deals just aren't worth any price, even if like, oh yeah, I can get this thing for like $20,000 and put like 80 into it and it's worth 300, right? But a property that's you can get for 20,000 that you got to put 80 into, and the time and like the financial loss and like the opportunity cost of like other good deals that you could have gotten into, I don't know, might not be worth it, right? So no really, really distressed properties was a big lesson. Always get an inspection was another one. We haven't been burned too many times, and when we have been burned, it's been like by a few $1,000s, not a significant amount of loss. But yeah, definitely get that inspection. Definitely get that inspection. Does your property manager deal with renovations before putting in a tenant? If not, how would it be done? Yeah, we only use full service management companies, and then we don't take on super, super heavy projects unless we have a really deep relationship with that management company in that particular area. So we're confident in giving them renovations, or we just don't bring them the renovation. We don't put our property management companies in a situation where we don't think they're going to succeed, or we make sure we try not to, right? I mean, obviously you're going to have like issues with your property's performance at some point in time, right? It's never going to be like perfect. You can't expect your property management company to be as cheap as you want, as fast as you want, and execute as successfully as you want. Even the really good ones. That's okay. I mean, like every business has its limitations, right? But I would say avoiding properties that are going to constantly challenge your property manager near their limit is going to be really critical. You don't want to push your manager to their limit. You want to have them operating a healthy level below their limit so that they have a higher chance of succeeding. You want them to have an easy job. If it's easy, you're going to do well. If it's hard, chance of failure, right? That's all it is. What else we got? Have I ever bought in Florida? Nope, I have not bought in Florida. It's a hot market. It's a really hot market. There's a lot of people moving there. And I think a lot of people will continue to move there. I think there's a lot of appeal to moving to Florida if you live like in the Northeast especially. People in the Midwest like to move there. It's got good weather. It's got a better like tax climate for higher earners. Property taxes are really low. The thing about it is right now with the trend towards investing in growth assets being so hot, every growth market is so under the public eye. Right, so you just say the word Florida, it doesn't matter which city, and investors are going, oh my God, growth. And they go in and buy because it's appreciated so much over the past several years, but because of where we are in the market, it may be really overvalued, money may be way too cheap, cash may be too abundant, and you might be paying too much for a good asset, right? You can buy a good asset and overpay for it. That's one thing I want you guys to understand. I don't dislike Florida and Texas and Arizona and Boise, and I think there's some issues with Boise when it comes to like their local economy's income and ability to support their actual like market and the demographic that lives there versus the outside money coming in. But you look at like Salt Lake City or Denver or even Austin, right? I always like say stuff about Austin. It's horrible pricing out there. It doesn't mean it's a bad city. It's a boom town is really what's happening, and because everyone knows that, they're very much like buying it based on like prospects of its future growth, but like that extreme rate of growth doesn't always happen every year for an infinite period of time. So it's important for investors to consider their buffers, their margins of safety. And I think cash flow is a big one. And it's just hard to find cash flow in a place like Florida right now. It is hard. I'm not saying it's impossible. You could find under market deals. You can go to secondary markets. You can get deals off market. You can find stuff that's under rented and increase the rents. And you can probably find a little bit of cash flow. Maybe you can find extreme cash flow if you get lucky. But it's a hot, popular, trending, growing market in a time where growth assets are a bit of a bet, I think. And it could be a winning bet is the big thing. But I don't like taking bets with my investments. That's just my profile. If that's your profile too, then you're not buying in Austin, Denver, Orlando, Tampa, whatever it is, right? Dallas, Phoenix, because it's just a lower cap rate than it's ever been by a long shot. And that's one thing I look at too, is like, the average cap rate in a market over time. Now, if it fluctuates very rapidly, then it tells me like there's some volatility. Like upwards volatility has some level of concern. It poses the question, could there be downwards volatility? If it's like stable upwards volatility, maybe not so much, right? But if it goes like whoop, and several cities are doing that at the same time, and there's like a global event happening, hey, maybe it could stick. Maybe it goes up and it kind of stays flat. Maybe it goes up and it kind of gradually goes up, like slowly after the fast jump. Maybe it like bumps and then corrects a little bit because people tend to like overreact to trends, right? Like kind of how when the stock market crashes. Think of it this way. People don't think of growth in the same way as they do decline, right? Like when the economy booms, people go, it's booming, it can go forever. What do you know? Or at least it'll stay here. But when the market like crashes really hard, don't you think, hey, this is too cheap and it's going to go back the other way? Like when the market crashed really hard in the end of March last year, I looked at a bunch of stocks and I'm like, this is too cheap. And like, yeah, I need to keep some cash in my business because there are some like struggles we're dealing with. This pandemic turned out to be good for us. But at first we didn't know. So I only got to invest like what I was comfortable removing and leaving a big reserve. I wish I did more, but I looked at it and I went, this is too cheap. This is going to correct. Correction doesn't always mean downwards. Correction means towards the norm, right? People overreact in the downwards direction. And when things are really good, people overreact in the upwards direction too. And I want you guys to understand that. That was a bit of a spiel, but it's kind of philosophical and it's really dependent on like human and consumer investor behavior. And what you guys got to understand is like the retail investors are more emotional, right? And the institutional investors, they have to act. They have no choice but to spend money, but they're less emotional nonetheless. They could jump on trends because they've got to spend investor money nonetheless. But retail investors are emotional, and it's known that in peaky markets or really, really hot markets, retail investor activity is higher than it is in normal or low markets, which means there's more of an emotional impact on valuation due to the high prevalence of retail investment or consumer investment in hot markets like this, which gives you reasons to watch out for certain things. That's all it is, right? Start with a rental or flip first. Two different businesses. Do you want to be hands-on and go in and make some revenue? Probably more money, but more execution, more risk. You got to be better at it. Or do you want to just gradually kind of push money into an asset class and keep doing what you're doing? That's the difference between those two. I will take one more question. Let's see. This is a good one. What are your thoughts on getting into Section 8? That TikTok Tom Cruise guy has a lot of success. It's Tom Cruise, right? Tom Cruise guy has a lot of success with it. So, yeah, he seems to legitimately know his stuff, to be honest with you. Like it's market by market, and from what I know about it, and I'm no expert, right? It sounds like he deals with it on like a super specialized level, and I don't. Right? I encounter it frequently, but I don't actually go and target it. I don't specialize in Section 8 rentals per se, just affordable housing and in very different markets, in a variety of markets. But from what I know, every like state has like a housing program, right? And there are local housing authorities attached to either on the city or county or even township level, right? And they all vary in how easy they are to deal with, how frothy their programs are, how accessible it is for tenants, how accessible it is for landlords to be able to get these tenants, what they pay for. Some of them pay like a premium to cover utilities for you. Some of them pay based on number of people. Some of them pay based on number of bedrooms. So they're like, it's important to understand the local housing authorities and the opportunities that it presents, and then also to understand that market and that asset class and that tenant class in that particular location. Because if that is a good product for the location, you're in a landlord-friendly state, there's high demand for affordable housing or fixed income housing. There's like increase of rents in that type of asset class at a higher rate than it increases in other cities, therefore it's relatively undervalued. That could be a great place to invest in Section 8. That's just from like an analytical standpoint when it comes to evaluating the market and the product. The ins and outs of like dealing with Section 8 properties, the operation of it. I'm not a property manager. I'm pretty sure Tom does have like a team that's in-house, like his own people managing his properties. So he gets to see that operation. I contract out to property management companies. So I just know what I learned from them, and I kind of let them handle the gory details. So great question. I'm gonna roll, guys. I am gonna say this on IGTV pretty soon here, and I'm gonna start that giveaway in a few minutes. Cheers, have a great Friday.